This episode of The Disciplined Investor is sponsored by Interactive Brokers. And here's something to think about. Will U.S. oil production exceed 14.1 million barrels per day for June 2026? At IBKR Prediction Markets, the yes recently traded at 35 cents, while the no traded at 63 cents. But markets can change quickly. Trade prediction markets on political, climate, and economic events with simple yes or no prediction style contracts, where prices reflect probability. Explore trending data, spot the trends, and if you get your prediction right, you could earn $1 per contract at settlement. Plus, you'll earn 3.14% APY on your investment with an interest-like incentive coupon. And you get $3 for signing up with IBKR Prediction Markets, which you can use for any purpose or to start trading. Prediction contracts are not suitable for all investors. Go to ibkr.com/predict and turn your views into IBKR prediction contracts today. The last trading day for this contract is August 31st.
The Disciplined Investor is all about you, your money, and the markets. Sit back and get ready for this edition of the Disciplined Investor Podcast.
This episode of The Disciplined Investor is sponsored by Horowitz & Company. If you're looking for a portfolio manager, look no further. Horowitz & Company. From seed through harvest, cultivating financial success.
Sitting on hands may be a good idea right now. Confidence versus courage, something we'll discuss, and a look at Q1, an insider's take. Our guest today, Thomas Thornton from Hedge Fund Telemetry. All this and much more on episode number 967 of the Disciplined Investor Podcast. Hey, Andrew Horowitz here. Welcome to April of 2026, the second quarter of this year. So far, no so good when it comes to the overall markets, particularly when it comes to March. It was fine up until the war, until we decided to strike and do what we got to do. But we are hearing every day that it's almost over, and maybe it is, maybe it isn't. Even if it said it's over, I'm not quite sure it is over. But until we get those Straits of Hormuz absolutely rocking back to the levels that it was before, where we're seeing every single ship that wants to pass, no matter what the flag is, passing, got a lot to worry about in terms of the markets, where we saw last week, what did it get to? 113, 114 for WTI crude. We saw Brent skyrocketing. We saw the prices of everything for a little while there get really hairy after President Trump gave a speech. And where are we now? Well, we're still into this, 2-3 weeks, maybe. That's the time frame that we're looking at to end this thing. I don't know how that's going to happen, but maybe it will. So we'll just have to look at it and accept it from there. But basically, we got to look at the fact that shocks rock stocks. That's what we're talking about in the quarter that was, particularly again in March, because we saw the ever-present news headlines, the tweets, the social media posts, the true socials, all of these rocking the markets. We had people like Secretary of the Treasury Bessent talking about this, and we have the Secretary of State talking about that, and the President talking about this. I don't know where the Vice President's been, but he's the only one that's been quiet in all of this. But all of these things are a big, gigantic elephant foot smashing down every single time, and markets react accordingly. And that is a big problem for those that are easily moved to get in and get out too quickly. Now, with that in mind, I will share with you that we did some work with client portfolios last week, and we moved to a different, more defensive, slightly more defensive position. And I thought it was a pretty good time last week to do so, and dropped global equity positions slightly, depending on the risk factor for our client portfolios. We moved and reduced duration down in our bond category, kept our commodities, which have been doing fantastic this year. I got to tell you, that is a standout area right now this year. But it was an interesting quarter. And I guess we'll start with the obvious point and kind of go through all this just as a quick behind the scenes until we get to the level where we're going to talk to our guest today. But it was a tough month, March. I mean, let's be honest. Let's just be clear. Nobody had the Straits of Hormuz closure on their bingo card. Did you have it on your bingo card? I don't think so. And yet we're here. We're right here. And let's talk about what happened. This is a geopolitical shock. Initially, a lot of people said, you know what, it's manageable. But it turns into something far larger. When you start going after people that have a theology-based government, where they believe that their leaders are close to God and you kill them, they're not just pissed. This is now a lifelong obsession that they're going to chase you down. The U.S. strikes and the Israeli strikes on Iranian oil structures in the latter part of February triggered a cataclysmic commodity shock that we have not seen in decades. This 20-ish mile wide Strait of Hormuz, this critical waterway where roughly about, they say about 20% of worldwide oil flows through there has been effectively shut down. It's opened up a little bit to friendly flagged, ships. Gulf states began cutting production last month. Oil markets, well, they became dislocated. And from there, everything had to reprice, right? That's where we are at this point, and that is problematic. This is a very good reminder right now that everything in 1 second in the world can change very quickly. And when it comes to your investments, you need to be aware of that. And that's why we have been preaching for 18 years now about diversification, our flower garden methodology, the multi-pronged asset allocation, our opportunistic and time-based dollar cost averaging. All these things that I've been talking about and teaching and discussing with you and implementing for our clients is exactly what this time period is all about. It proves once again that when you build a portfolio with resilience in mind, that you don't have to be all gains or all losses. So coming into March, conditions, I think, were relatively constructive, right? January and February were calm. Earnings held up well. Markets entered the springtime season with, I think, a reasonable level of optimism. But once that oil shock hit, boom, everything changed. The S&P was down nearly 9% at its low from its January high. And it didn't reach that all-important technical correction that we call at 10%. But what it did do was do some damage to the underlying stocks that were in it, as well as the markets themselves. The drawdown was the worst monthly performance in more than 3 years. The NASDAQ, of course, fell a lot further. I don't think that should necessarily surprise anybody. It was a high flyer for a while. Valuations were off the charts. And when you see that energy prices spike, and of course that secondary nature that inflation is going to come, and what's going to happen then? Well, the Fed's not going to lower rates. Higher valuation stocks, the growth stocks, can tend to get hit first. What did hold up? We saw the likes of energy and utilities, consumer staples. We saw materials do better. Energy was great. Energy, commodity-based energy, whether it was heating oil or natural gas to a degree for a little while there, then it popped back down. But anything related to oil, crude oil, did great. And what that did, where you had exposure to this in your portfolio, it softened the broader pullback. Exactly, by the way, what those positions can be beneficial for in your portfolio, this kind of environment. One important backdrop of this whole thing that I think deserves some attention that really wasn't not looked at as closely because it's usually kind of boring. What happened with interest rates? Interest rates expectations on what the Fed was going to be doing and the outlook on bonds shifted, I dare say, as violently as the price of oil. Because just a few weeks ago, markets were pricing in two Federal Reserve rate cuts, right? They were thinking the Fed was going to drop the rates twice. And everybody was all like, yeah, that's going to happen. You know, the jobs market's slowing down and the Fed wants to do this and make sure that they have all. And okay, great. But by the end of March, most participants were openly discussing the possibility that, well, maybe we're not going to see those cuts. And just a few of them were actually talking about, dare I say, the possibility of a rate hike. And that kind of reversal adds a whole nother layer of pressure to equities. And I think it explains a little bit about why markets struggled to find footing during this period. Now, when we look outside the U.S., global investment, when we look at the emerging markets, we look at international, which did extraordinarily well the final quarters of 2025 into, amazingly, just a huge run into 2026, turned around just as quickly as the dollar moved up in value, and the concern that the reliance on many of these countries for oil that was directly from the Strait of Hormuz was going to be pretty much cut off. Dare I say, South Korea. Do you take a look at that particular ETF, EWY, symbol EWY? Wow. Pretty amazing. So of the 9 major international indices, let me get this out. Japan. Okay, let's start with Japan. Japan, up 6% for the year to date. UK, the FTSE was up about 2%. Canada was a little bit up. Germany fell 8.2%. France 7.3%. India was the steepest decline, about 15%. Now, Japan, of course, we know the yen is weak. And a weaker yen boosts exporters, and monetary policy there remains, I would say, looser than most of other developed markets. India sits on the other edge of the spectrum, one of the world's largest energy importers by a distance. And this oil shock really threw everything into a tizzy right there. And Europe, once again, facing challenges. But one of the biggest surprises this quarter was China. Factory activity actually expanded at its fastest pace in a year in March. And that's amazing. That puts this squarely in the, that's good stuff. Why? China has been able to source discounted Iranian oil and had a huge amount of backlog of oil. The big issue we go into, though, into this next quarter is, and I think what's really haunting a lot of investors and why there's been such a move to change your bond positioning and your equity positioning, is that before the conflict escalated, inflation was actually moving in the right direction. But now, after we see that headline CPI was 2.4% with core inflation at 2.5% through February, there's a big question. We're going to have some inflation. Is it going to be transitory because it's just these higher price of oil and potentially agriculture? But this is a big issue because it's really going to be a problem. And the problem really is about how long prices will remain elevated. Now, it's interesting because what will end up happening here is if oil stays elevated for a long period of time and the gas at the pump goes up, people are going to start laying off, buying other things. Those prices will come down. So inflation will, to a degree, moderate. But remember something that I think is the most important part of all this that seems to be missing on most people is that the price of oil is not just at the gas pump. It's not just at the airports. It's all the things that the petrochemicals are you deal with the petrochemical industry and how many things are made that have some kind of petroleum base in it. That's a big issue. And I think we're going to see central banks very sensitive to this whole scenario. They're concerned about inflation, but they realize that part of it is based on just one thing and one thing only and can turn around very quickly. The IMF is concerned. They said, I quote, all roads lead to higher inflation, slower growth. And this whole tail risk scenario about the Straits of Hormuz remaining effectively closed into April, and if it takes longer than expected, there's some people talking about Brent crude oil reaching $200 a barrel by mid-year. Not a high probability outcome in my expectations, but it's something to consider. So bond markets have been a bit worried about this, so that's a problem. 10-year inflation, 10-year Treasury yield ended March at 4.31. It was 4% and going down just a little while ago. High yield spreads widened. Municipals outperformed. That was good. Aluminum prices surging as smelting capacity was disrupted. Steel price in the U.S. rose, as did in Europe. European producers, especially exposed due to the reliance on natural gas. Big problem there. Gold prices briefly were into the mid 5,000s before retreating down to about $4,500. So the Fed has a lot to consider right here. They held rates steady at 3.5 to 3.75 in March. Not a surprising situation, but we did notice the tone was a little bit more cautious than markets hoped it would be. So we got a complicated situation with Powell leaving. And when we look at this, the good news to a degree, there's a good and a bad. The good news is, compared to like 1973, the U.S. is a net energy exporter right now, so that's good. Higher oil prices hurt at the pump, but they also benefit domestic producers. You've seen the XLE and a variety of the other stocks within the sector related to energy have done extremely well. What we do know is that, generally speaking, these geopolitical shocks tend to fade well before the inflationary effects do. And markets often recover on expectations well before the conflicts are over. The key question still remains. Is energy-driven inflation going to last long enough that it becomes embedded to affect core inflation over the coming quarters? And that's something that is very concerning. We saw some February jobs reports, CPI, PPI, retail sales. Again, most of these don't have the impact of what's going on right now. And that's something that we're going to have to watch very carefully. And I think we'll follow up with a good amount in the upcoming shows to happen. Next week coming up, Claire Flynn Levy, new book out, really good. Tom Nelson, head of asset allocation at Franklin Templeton, and a whole bunch of other guests that are going to be coming in the short term. I want to get to our guest. I want to talk about, for a moment, just take a break. I want to mention Interactive Brokers again and ask another interesting question regarding forecasting. Will the Fed raise rates by 25 basis points in June 2026? We're talking about that here. With Interactive Brokers, you can trade prediction markets on political, climate, and economic events right alongside stocks, options, and bonds, all in one account. IBKR prediction contracts price reflect probability, and correct predictions earn $1 per contract. Plus, you'll earn interest on your position. You'll get $3 for just signing up with IBKR prediction markets. Prediction contracts are not suitable for all investors. Listen, seriously, this is so cool to check out. You can see all this stuff ticking live right in front of you. I want you to go to ibkr.com/predict. ibkr.com/predict. The last trading day of this contract is June 17th, but if you want to check out how, you've been hearing about this stuff. If you want to check out how it looks and how it feels and what it's about, just go there and check it out. You're going to be amazed. It's pretty cool. All right, let's get to our guest. And our guest today is Thomas Thornton, a good friend of mine. He's a former portfolio manager, a senior trader, technical analyst with Level Global Investors. He's written a daily market note for a select group of hedge funds and managers for years and has now put that out actually for investors like you and me called Hedge Fund Telemetry. And he has a long-term focus on sentiment indicators, borders on what he calls the obsessive. And he has been growing and doing great. So let's welcome. Hey, Tommy, how are you?
I'm good, Andrew. How are you?
Good. You know, you and I have talked about racing and your passion for F1. You know what I did recently?
What'd you do?
I did a few laps down in Homestead Racetrack. Yeah, we did the Italian package from Extreme Experience. I drove a Ferrari 488 GTB and a Lamborghini Huracan and took that around the track 3 times, a road track down there. So
someone else's cars. That's really nice.
Yeah, no, it's really nice if somebody else's. Although you had to buy the insurance. The insurance was a big part of it. Like, do you want the, $10,000 insurance? I'm like, well, what is that going to do? First of all, it's not insurance for me. It's for the car. You want the one for $7,500 deductible, the $10,000 deduct. I ended up getting something like $50,000 of insurance because if you nick that car, it's $50,000. And
those cars you can they're nickable.
Yes. Well, I took it up to about 135 miles an hour around the straights. The Lamborghini, I did a little bit better. That was my second car I raced, so I was a little bit more comfortable. The first time around, I was a little nervous.
Yeah, I can see that.
Yeah, the guy's like, put more gas, because you sit in the car with a coach. He has no controls of it at all, which scared the hell out of me. Right? Because you're coming around stuff at 130 miles an hour. Now he's like, okay, brake hard because you got to make that turn right here. And you take you're taking that turn at 30, 40 miles an hour easily, which you wouldn't do it in a car. You do it.
It's not easy, Andrew.
No, I know. In a car, you do it at 4 miles an hour.
It's not easy. Well, I'm a long-term Formula One fan, and I'm rather distraught because they changed the power units and the motors, and none of the drivers like it. You have Max Verstappen, who's threatening to quit the series. It's not very good.
What did he do? Did he pull it back?
Well, they've sort of put more electricity involved, and you have to recharge your batteries around the track. So when you recharge your batteries, you have to get off the throttle, and when you do that, it's not like an old typical race car where you go flat out into a corner, you brake, and then you go around the corner and you're flat out again. You have to coast. It's just it's a mess.
No good.
It really is.
Let me ask you something. Let's stay on the car topics. So I want to start out with this very narrow topic that I'm going to throw at you, and then I want to talk about bigger picture of what the hell is going on in this market right now. So, Tesla. Can we talk about Tesla for a second?
Yeah.
Here's a twisted theory that I have. We saw that Tesla came out. I don't know if you're a Tesla holder. I'm personally short Tesla.
I'm short Tesla right now.
I've been short Tesla for a while.
I've been a long-term short.
Yep. Same with me.
I trade it, so it's not like I ride it. I trade around my position, but I am short, and I think they have problems.
Yeah, they do. Here's the thing, though. What do you think about this? They have terrible sales. They came out with a 14% reduction compared to last quarter and just miserable. Let's just use the word miserable. I think it sums it all up for their car sales. And they stopped producing the S. Looks bleak. But there's this big SpaceX thing hanging overhead, which I think has been the reason why it hasn't really dropped even further. There's an IPO coming out. They're talking about possibly rolling up all the Musk entities right into one. I'm thinking, do you think this is actually a purposeful move by Musk to take that price down so we could buy it on the cheap and roll it back up into SpaceX?
I don't think he ever wants his stock to go down, but
you wouldn't put it past him either, right?
Again, I don't think he would want his stock to go down. And worst case scenario for him is he would roll it in. But let's just think about rolling it in. And I'll start with SpaceX and XAI. XAI is a money-losing endeavor that has Twitter and its AI platform and such.
Mm-hmm.
And they rolled it into SpaceX with a valuation of $250 billion. Now, the founders of XAI, I think there were 13 of them, and Musk is one of them.
Mhm.
13 have left the company before this IPO. And if you were a SpaceX private holder,
Yeah.
you've just been diluted about 25% of your position in this. And there was no real say in this other than what Elon wants, Elon gets. And so I think it's just a little sketchy, and it reminds me a bit of Solar City, and it's sort of
Oh,
a
totally.
bailout.
Yeah. By the way, it totally reminds me of Solar City. I was going to mention that too. I mean, it's almost identical, except for that fact that Solar City was really losing a lot of money.
You know, the funny thing about Solar City that not a lot of people remember, I do, is they did a secondary about a year before they bought them out, and it was for 26.50. That was the price. And the stock went down to like, I don't know, the teens, low teens. And then lo and behold, and Elon was a major participant in that Solar City secondary. And lo and behold, the buyout price for Solar City was
Yeah. Yeah.
26.50.
No kidding. Just like the buyout price for this could be 420.
You know what? It could. It's just you're dealing with a lot of big numbers right now, and even space. And look, I'm not a big fan of the SpaceX model, partly because I think it's not an easy model. You're dependent on the government. You have the uh, ability with the satellites and what is it? Why am I blanking here? Starlink,
Mm-hmm.
and that's a business, but it doesn't make like gobs of money. It's nice and it's cool, but there's a lot of competition for internet connectivity, and now Amazon might be buying Global Star, which is a competition. So for 9 billion, and saying that SpaceX is a 1.75 trillion-dollar company,
Which is absurd.
and it's trading, with that, it would be trading somewhere north of 100 times the revenues. You know what? I just think that they're going to this is how I see it. And I'm not participating long or short in this one for a while. They're going to do a small number of shares
Yeah. Small float.
in the
Small
float.
float. Yeah.
Yeah. And because that's worked for IPOs. And then 6 months later, they will do a secondary, and secondary or just insiders will have their lockup end, and they can just
Bail.
basically
Yeah.
bail out.
Right.
And that, I think, is the plan. That's when I would probably be more interested in shorting it. I don't like space travel from a fundamental reason. I love the whole idea of traveling to the moon or whatever, but it's just a lot of money at a time when there's so many other problems in the world that we could be deploying money to fix what we have here on Earth. But that's that, and I'm not like Mr. Green, I'm not, tree hugger or anything like that. It's just I think there's a lot of better uses for that
Well, the
type of
idea is to
money.
get the hell off this planet, this spinning globe, right? That's the whole idea
It's
that
a
Elon
huge
has.
amount of money that you're doing, and you also run the risk of having a un, an unprepared or um, a disassembly, as they call it, unintended disassembly of the rockets. It's very dangerous.
Well,
So
by
I
the way,
just,
and I want to see though if all the things, because a lot of things in Star Trek came true, right? Let's get, you got a lot of things that kind of like, wow, that's cool. I want to see if in fact aliens have the same bodies as we do, just different heads, just like in Star Trek. Remember that?
yeah, I mean, I'm waiting for Elon Musk to talk about teleporting.
Oh, that'd be
That's
fun. Yeah.
the next thing. But I also think data centers in space is something that makes really very little financial sense.
Mm-hmm.
And from all the research I've done on does it really work? Data center is a complex situation. Needs a lot of maintenance, updating. Things break. You have to replace servers and chips and cooling all the time. And it really doesn't make sense when you have something that's floating up in space and you got to go back and you got to fix it. It just it sounds too good to be true, and it really doesn't necessarily cool things in space. There's a problem with that as well. So you're taking a complex situation and making it more complex and more expensive. So it just doesn't make sense to me.
Not to mention that's a really, really long Cat5 cable that you got to string.
Yeah, there's latency issues too, as far as data
Clearly.
coming from space
Yeah.
to Earth. You're right.
So let's set the stage for a bigger discussion. I want to talk about all of those people that are listening and things that they're doing about what's going on right now, implementation in this particular environment, what the big boys are doing, how we can do it. So we've seen that all the data is showing that hedge funds and institutions are in the process of, I guess the best way to describe it would be unloading the hell out of shares. They're starting to sell pretty well. We've seen the book from Goldman come out recently. We've seen that there's been kind of a tilt towards hedging, shorting, selling. First of all, we know that going into this, let's just call it February 25th. I'm just picking a date. Before the notion of, oh my God, let's go to war. That's a good idea. What happened was we saw a lot of margin and leverage being pushed into the system. One of the largest amount of margin we've seen in a long time. As a matter of fact, there was his historical levels of margin that we hit. So the question I ask for you with all that as a backdrop to begin with is, how long can selling go on in this environment?
And pardon me, I have a neighbor with his gardener doing the blow outside. If it gets
Doesn't he know we're doing a podcast?
Can you hear me okay?
I can hear you fine. I can't hear them.
Okay, good. I apologize. So a couple things. We had humongous inflows into the equity markets over the last year, and flows continued from October through January, really unabated and just massive amounts. And the markets didn't really go anywhere. They went into this narrow range, and the positioning, I think, has a lot of people holding stuff higher. Now, you can look at for example, everybody's talked about the Mag 7. The Mag 7 is down, that group is down 12% year to date, and the S&P is down about 5%, 4% right now. Qs are down 5%. So you have a lot of people that have been crowded into a lot of stuff. It was narrow. And I think it's the longer we go on without these performing, that's when we're going to start to see real money come out of the market. And I've seen the Goldman data, and I think you had a lot of fast money that shorted stuff. And I've been really good at identifying places in the market where people are offsides with positioning. Now, last Thursday, I forget, it was in late March, we had a really awful day. And I was chatting with one of my institutional traders, Dave Lutz, who's with Jones Trading, who's just a phenomena. He said, Tom, it's the second lowest volume day of the year, next to January 2nd. And I thought, well, that doesn't seem like capitulation. And he handles a lot of large mutual funds, the ones that are based in Boston, the Fidelities, Putnams, the usual suspects. And he said he has not seen them do much. They're not selling. They're sitting on their hands. They're not necessarily in a giant rush to buy. It is, the first quarter, and they're not necessarily desperate to panic, even though all those funds are down on the year. I think we've had this buy the dip mentality. And last year, the buy the dip mentality was to buy every 1% dip. And now we're starting to see the dips not work as well. And, it's sort of mindless when you have a market that's just sort of more in tune watching what the president is saying on his social media. And that's inconsistent as well. We don't know necessarily what's going to happen, but I think that the more he does that, the less the market's going to respond favorably. And let's just, the elephant in the room is that you have the average uh, price of unleaded gas in March is up from March, the beginning of the Iran war. It's up almost 40%. A 40% move in the average price of unleaded gas is going to move inflation higher. And it's also the number one trigger point for consumers to get really nervous. And they're talking, you see it on the news, you see everybody, showing the prices in California or wherever. That that hurts, and that's going to cause consumer slowdown and spending on other things, on consumer just discretionary stuff. And I had someone yesterday say, "Well, the retail sales weren't bad." I'm like, "Those were February, and you didn't have a 40% spike in unleaded, the average unleaded gallon of gas." And that, to me, I think is really going to be a tell. And the longer it stays higher, it takes more money from consumers' wallets away from other things. And that is a concern. That, macro 101 it's a huge, huge issue.
Well, we know that there was also a lot of an uneven amount of pain and gain in the markets, right? When I say the markets, I'm talking about in economically, like big picture, right? Where we see that this K-shaped economy, which is real, by the way, and we see that there's people that are in the lower strata of income get hurt disproportionately more because what's happening here is they're on a fixed income, and with a fixed income, when you go from $2, $3 to a gallon to $4, $5 a gallon, all of a sudden you're required to go to work, pay for that gas. You're not at the point where you're starting to do the carpooling thing yet, right? Where you're going to start doing that because right now it's temporary. It just went up. I could deal with filling my car up this week. Next week becomes a problem. When you have $20, $25 per week of excess in cost for gasoline, talk about $100 a month, $1,200 a year, that is like a reverse stimulus. That starts to hurt. And now you have to pick what you're doing. Maybe you're not traveling to go on a vacation. Maybe you're not buying something that you would have bought, a discretionary item. You would have bought maybe a new iPhone. You're not buying it. Maybe you're not buying the clothing. You're buying your food, but now you have the double problem with food. So I talked about this a couple of weeks ago, Tom, with regard to what we're seeing with food costs right now, and a concern. I'm going to just restate it for you, and then I'm let you take off on it, okay? The problem is that we saw a really horrible situation in the beginning of this year with the cold snap in Florida. Many of the parts of the nation, they are the Florida citrus and vegetables are a big part of what they buy during in the early parts of the year when it's cold elsewhere. And that was a real problem because we saw yields on like corn and other vegetables go down to virtually zero. Strawberry prices are through the roof, fruit prices are through the roof. And now we have the next stage, which is the spring planting season. And in the spring planting season, one of the things that we're reliant on is like nitrogen and various fertilizers like urea that is stuck in the Strait of Hormuz, which is going to be a problem for yield again moving into the second part of the year. So now, whereas we have higher gas prices, the potential for higher prices on all sorts of not only agriculture, but foodstuffs is going to be a problem. Now, put that into your calculus of, let's say, second quarter, third quarter consumer operations.
Well, you're absolutely right as regarding the fertilizer, and that's a global problem where there could be, food shortages, not necessarily in the U.S. but in other nations and nations that really depend on higher yielding crops. And so that, to me, I think is a global concern. It's going to raise prices. I think that that is a really big a big problem that I hope I hope this whole war ends quickly. I was hopeful that and trust me, I have a lot of Iranian friends that I grew up in Los Angeles, and I knew, was close with some friends that were expats from Iran, some that were close to the Shah's family. And, they're thrilled. They're like, we just want that regime gone. They're an awful regime. And so I'm not necessarily a fan of Trump. I'm still lock limit short Kamala Harris and Joe Biden. I'm lock limit short most politicians, but the
Lock.
thing is, I was hopeful that there'd be regime change and real change with an oppressive country. But the longer this goes on, and if we don't get the resolution fast and the Strait of Hormuz opens, I think there's going to be a real problem. The other thing is, you know, regarding the markets, I've been pretty good as far as, you know, being net short from January. I'm still net short. I've covered some things. I have about 20% in cash. I look for opportunities to buy when things get oversold. There's capitulation. Market sentiment gets really weak, and market sentiment is weak right now. I just don't have all my indicators lined up. The DeMark indicators show downside countdown still in progress on the S&P, Nasdaq, the Dow, the Russell, and others. The other problem is that, and this is really, where I get, very nervous, is that when you've had a stock market that goes down, usually you have bond market gets inflows, and the bond market has seen rates move higher and the bond market going down. And that is a double whammy.
Well, the problem, Tom,
Because
would you agree that the problem right now is a trust factor? One of the things that the markets go on is, in God we trust, backed by the full faith of, things like this that are some of the core basic philosophies that we have now where there is no backing of, let's say, our currency. And in an environment that, well, every environment, what is the backbone of a stock market is confidence. When you lose the confidence, that's a problem, right? Because if you're confident that 10 years from now, 5 years from now, things will be good, you'll be buying, you'll be doing fine. Short term, you need the same thing. The lack of, let's just say, honest reporting, information, the true social stuff, the clear and present and very obvious, constant saying things just to prop up markets. Let's not even talk about what happened last week with the $1.5 billion buy-in to index futures and shorting of oil 15 minutes before the announcement was made by President Trump, right? That's not just a little note to a friend. That had to been a broad-based, big position move.
Yeah, there's been a lot of that, and it's awful, and it's just sort of what the situation that we have currently. And I think that you had both sides of the aisle doing a lot of that type of
Clearly,
stuff.
yeah.
And it's pretty just much in the open today.
And by the way, there's an ETF that's dedicated. The Unusual Whale Subversive is an ETF dedicated to finding what insider politicians are buying. All I'm saying is that we're not instilling confidence right now, which is a bigger problem on top of the fact that things are already coming out of markets where we're having prices that were increasing when they were supposed to be going down. And now we have this war and the oil and all this going on right, by the way, in the front of midterms. In the front of midterms, this is being done. So
it's not good.
Does this environment, right now we have oil clearly over 100 sticking around there. It's going to impact consumers, you said. Does this remind you right now, snapshot, more of 1973 or March 2025?
I would say I've written about parallels with the 1970s, where you had a double rip with inflation, and it was caused by some things that were different, but it happened to be with the Middle East and oil prices going higher and inflation going higher. I think it's very clear that the Fed, with all of this going on, they can't do anything. And with a new Fed chairman who probably said, the first thing I'm going to do is cut rates, I think that that's going to backfire, and the long end of the Treasury the rates will move higher. And the problem with Trump is that he thinks that the Fed is going to lower rates, and that will lower mortgage rates and the long end. But the Fed really only has control of the 2-year. And if you have a huge deficit and you have a huge full national debt, and both parties can take full blame for that, but that's going to, keep rates elevated. The one thing that would probably get the bond market to rally is if the equity markets
Collapse.
really took
Yeah.
a further dip down and you really had consumer confidence weaken. Because I don't think we've seen capitulation. I don't think we've seen enough pain in the market. I think it's just become more an annoyance. I think people have a political fatigue that is rampant. I do. I mean, I just want to bury my head, in my pillow at night and just go, I can't take it anymore. But it's and most, portfolio managers, I can tell you from being one, it's very difficult to have any trust. Like you're saying, you just don't know what to trust and what's coming around the
But that's
corner
what
next.
that's what I'm talking about. I'm talking about the trust factor, the confidence. That's why bonds have been going higher. That's why the dollar has been going lower, except for in the war, because the safety trade between the Swiss franc, the yen to a degree. Well, not the yen anymore. Actually, they're selling off the yen, but the dollar has become the safety trade, and that's only in a very strange time. But before that, the dollar was weakening precipitously.
Well, the dollar is something that typically when there's market turmoil or geopolitical turmoil, the dollar rallies. And the other times you had the bond market rally as well. But one thing that a lot of people also don't understand is that uh, as you started the talk today, a lot of people are leveraged. A lot of people are super long this market, and they have been, and they need liquidity. So there's a lot of, what happens in markets that have these problems. They're going to, portfolio managers or, large funds or sovereign wealth funds, they're going to sell whatever's not nailed down. And gold and silver can get thrown into that as well. And you had huge, huge inflows into those not too, far back. And I actually I shorted gold, and I told everybody, I said, I just think positioning is way off sides. And I covered it, made 10%. I bought it, last week and sold it yesterday and I made 4% on the upside. Gold, a 4% move used to be a whole
Oh my
year.
gosh, that was astounding. Now you have silver that's moving 10% in a day.
Yeah, it's pretty crazy, and it's become more of a meme type trading vehicle. And I thought it was just positioning was offside, so I have no position in the metals right now. Again, you also have this private credit problem that you're losing confidence there. I happen to be pretty good friends with the founder and CEO of Blue Owl, and I haven't seen him for a bit, but there's very little confidence in private
21%,
credit right now.
21.5% repurchases that they just announced this week.
Yeah. That happens. That
Well, the
happens
problem is
with
it
hedge
shouldn't have
funds.
happened because they sold everything to retail on this dream that this would be a great opportunity. And I talked about this, and I don't want to talk about this because I've talked about this to death. But the bottom line is you told retail in passing that it wasn't able to be gotten to, your money would be locked up, but you really didn't do that. You sold them on this dream. They can get an extra 200 basis points over normal, with a period of time. And the bottom line is that because they don't really mark to market on a regular basis, you don't see any kind of sway in your valuation. And now what's happened is because there's a rush to the exits. But I literally don't want to talk about this. Seriously, let's stop that. I want to ask you this. When you look at today's markets, what stands out to you as the biggest risk that most investors are probably underestimating?
That's a great question. Well, first of all, I think people have been accustomed to seeing their portfolios go higher. And if they're just patient, they go higher. But one thing that might happen is that they may go sideways for a year. They may go down more, and they'll start to look for other things of what, you know, where can I put my money other than the spiders or Qs? Where can I go? And that happened in the 70s. That happened in after the tech bubble popped. You didn't have the Nasdaq make a new high for a decade, and there were a lot of trading opportunities. And certainly there'll be. I like this environment. I'll just say this because I like trading opportunities. I like seeing dispersion. I like seeing things get crushed down to places where people panic, and I can buy them. And that's what I'm looking to do. I'm looking to be a buyer of really high quality. So what I try to tell people is when you do have these dislocations in the market, it's the time when you want to add quality to your portfolio that you couldn't buy uh, you couldn't stand buying it at the higher valuations. And the same thing happened last April when everybody panicked in Liberation Day. I did this, everything was getting to my levels that I wanted to see. I thought the S&P would be under 5,000 at some point in 2025. We got 4,800. Everything was oversold. Market sentiment was at 10%. We're at 15% right now. And sentiment can stay down. So it's not
And
necessarily
by the way,
like just
we're
a
at
trigger.
15% with only a total like 7% drop in the S&P 500. Now, mind you, a lot of things held up like the energy, but that's a small part of the S&P 500. Healthcare, utilities, all held up, staples. But the tech came down pretty well. But still, that was only down. If you look at just tech only, it was down probably, 14% maybe from the high.
Yeah, you have it like you have the biggest weight. Nvidia's down 5% for the year. It's basically
Right.
in line
Exactly.
with the S&P. Apple's down 6%. Alphabet,
Microsoft's down pretty good.
yeah, they've got a problem with their cloud, and I think ChatGPT is not necessarily turning out to be great for them with Copilot. I'm hearing not necessarily great things. I would probably be a buyer of Microsoft a little bit lower.
Yep,
Great company,
I agree.
very steady, but it's got to get to my levels.
So,
So I think that you're going to have to wait and see a little bit further down. If we get a capitulation, and for people that one of the things that I want to see is, of course, on the websites and newspapers when they always show a trader on the New York Stock Exchange, which I don't even know if there are any there anymore other than CNBC. But when they're holding the face to the hand
oh yeah,
indicator,
or
the face to
better.
the hand
No,
indicator.
the other one, the CNBC markets in turmoil.
Yeah, that's usually a pretty good sign of
Or when they
of
start
a-
bringing Jeremy Siegel out on a regular basis more often, when they bring out all the bulls, they just march him out there and they start doing that. But when it comes to that, first of all, the obvious question, and I got a secondary question, how do we know? Is that the signal really that investors should look for about capitulation? What is that? What is it? Is it the high volume day that's maybe 2 times the average volume on a stock, or maybe something on an index? I mean, what is really, how do you know?
Well, there's a lot of different things. One thing I like to look at, real high put call ratios. So if I'm seeing put buying off the charts versus call buying, and I run a 5-day moving average of the equity put call ratio. If I see that spike higher to levels where it's like people are buying insurance on their house, it's on fire. It's too late. It's not going to work. That's kind of what I want to see. I like to see when the percentage of 50-day moving average within the S&P gets under 20%. It's moving towards there. I like to see DeMark indications of buy signals, which I show on my site every day. I like to see an overwhelming amount of buy signals within the S&P. If I can get 10% or even 20% within a week of signals within companies, that's a good sign. I like to see when you see again it becomes front page news and it's on the nightly news. The stock market got killed today. That's the kind of stuff I want to see. But again, I think it's something to consider for people. It's a long year. If you're nervous, you can move to cash. You can always buy back anything, or you can buy better quality if things go lower. I just think that right now there's so much uncertainty. It's a friggin' war with a adversary who's not necessarily waving the white flag, and I just get worried that they could, do something that stands out a little bit more, and that's my concern. I obviously we all don't want that, but
So
it's
how do
something.
investors, how do you get involved? If you pull your money out, this is a big problem. So investors will say, I'm going to cash. Get me out. I'm going to cash. I don't want to deal with this, right? The problem is that it's never looks like a good time to get back in. Well, it's going up. Oh, well, it's a false breakout back up. It's too high. I want it to go lower. It goes lower. And what do they say? Oh my God, it's going lower from here. So my question on that would be like, how should your average person that is not simply writing it out, how are they dealing with position sizing, not overexposing themselves? We do something here called 1 foot in, 1 foot out. It's a very simple and very basic concept where we don't have investors that are in cash, let's say, fully exposed at any time. We do a multi-pronged dollar cost averaging approach to get them back into the market. And then, by the way, full disclosure, Tom, we actually reduced positions this week in equities for the first time in a while. So
I have no problem with that at all. I think that one thing I try to stress to people is if I'm initiating a position, there's a lot of times where I'll just put a 2% weight of what in my portfolio in a particular idea. And if I like the idea and I've done my fundamental work and the technical work lines up and I get a little bit lower, or if it even goes higher, I can add up to 5%. And I keep my position weights there. I don't try to, if I'm down, I don't try, one thing I don't do is I don't try to make it back up in one trade. If I'm wrong in something, sometimes I'll just take that off my board and say, I never want to be involved in this stock again, or I'll see you months from now. I don't need to be here. A lot of people will try that blackjack type of thing where they lose 3 times and then they put more money down and try to make it back in one hand, and that is ill-fated. It could work, but it's ill-fated most of the time. So the best thing to do is, when dollar cost average yourself in, buy the highest quality, buy the companies that you wish you could have owned when they were at the highs, that are solid, they're not going anywhere. If Apple went to 200 or below, you buy it. Last April I was buying Nvidia under 200. I was buying Apple under 200. I tried to just get into every possible thing I could at levels that I figured were good enough to own. And
obviously it's a trade-off, right? It's the whole. But what about position sizing? You don't go you don't go in full bore, right? And explain that in a very easy to understand, because I know we talk about it, and you and I will talk about it. We get it, but I'm telling you, for some people, it's like, okay, what exactly do you mean?
Well, one thing that I try to not have more than 20% in one sector. I try to not have more than I don't have more than 5% weight in one particular idea. I don't recommend people trying to buy options, call options to make it back. Sometimes when you get hit kind of hard, and the market could get hit hard, the worst thing you can do is try to make it back so fast. And if you give yourself the diversification in the best quality companies that have gone down because of the market, and not necessarily because of some problem that it's your BlackBerry and all of a sudden the iPhone comes out, I'm going to buy BlackBerry. You want to stick to those solid quality names that get beat down and do your work, do your valuation work, and just be, somewhat patient. It's easy. You lose money a lot faster than you make it, and I think people have the wrong idea these days that they want to make their money really fast, and it's frustrating for me because I've always lived in that realm of making money slower, and today it's the zero date to expiration options. There's triple levered stuff, and people are trying too hard to make money and gambling. And I find that to be a troubling problem in the world.
One of the other things that's really difficult is doing nothing. A lot of people think you have to do something. And I think this whole idea of doing nothing is kind of interesting, where most people get it wrong on this whole doing nothing. Doing nothing doesn't necessarily mean taking everything out and putting it into cash, right? There's a doing nothing wrong and doing nothing right, doing nothing correctly. What does that look like for you? And maybe some things that you can impart to investors. If you agree that there's, maybe we don't agree with this, I don't know.
Yeah, oh, I know. I 100% agree. I think it's very hard for people that are staring at their screens or their phones or whatever and seeing other things go up, or, and they think, oh, I'm missing out on that. Sometimes it's like a psychological boost to take some time off, and do nothing, sit in cash. Everything's going to be there a week from now, or it's better opportunities. And forcing trades can be, dangerous for your portfolio. And just look at the back and forth that we've seen. We've seen these incredible gap downs, gap ups. These can just chew people up. So I'm more than happy to tell my people, I'm sitting in 20% cash, and I just don't have the confidence to be, reversing and turning net long at this point. I think there's still more downside ahead. I would love to say we got the all clear, and when I do, it's usually when people say, "Are you sure?" they think I'm crazy, but all the indications that I have, and I've used these for decades, they line up, and I don't need to get 100% of all the indicators on the buy side. If I get to 75%, I'll start moving into the long side. But we still have a lot of unknowns out there, and I'm okay with some unknowns, investing into unknowns, but valuations are still elevated. I'm not quite there yet, and I'm more than happy to miss an opportunity rather than lose money.
As you were talking, I was thinking about something. There is a huge difference between confidence and courage. And what I mean by that is when you use the word is, I don't have confidence in the market, so therefore I don't have confidence in that investment right now. I don't have confidence at this level, right? That's how we describe it. Would you agree? But it's not, Tom, it's not you don't have the courage to do something. That's a whole different discussion, right? This is confidence that utilizing your fundamentals, your technicals, whatever it is that we particularly use to get a level that we believe is the right thing is the point. The courage needs to be there to act once that gets there. The confidence and courage, totally two different things. They do overlap at given times, but I think there's an important distinction that has to be made for that.
Yeah, it's funny because usually when and Stan Druckenmiller said this recently in an interview that he did with Morgan Stanley. There's a lot of times where I'm buying I'm turning net long, and it's still, I don't have the highest amount of confidence of exactly this is it. Everything's going up from right after I buy them, and if I have too much confidence, then I'm probably going to be wrong. So I like to have a little bit of nervousness of when I'm doing something. I know that sounds like, oh, we take all your emotion out, but the bottom line is it's money, and you're making a call on something that may or may not work. You just have the probability of, when what's my time horizon, what's my sizing, what's my risk level. And if you have that in mind, you do have a bit more confidence. It certainly worries me when I have way too much confidence in something and it doesn't work.
But with Druckenmiller, what he's saying is he has the courage to his conviction, but he may not be confident in the exact pricing. He has the courage to do what he needs to do.
Well, I think it's partly, and I get it because I'm sort of on the same mindset where you do your research, you do your fundamental work, you look at the technicals, you look at, how people are positioned, and it gives you the confidence to make that call and say, at this level and at this price, with everything that's going on and everybody, nervous and panicky and it's oversold, you can start to inch your way in, and you're 1 foot in, 1 foot out type of thing. I'm very comfortable doing that.
Yeah, good stuff. Thomas Thornton, Hedge Fund Telemetry. Tell us where we can get information about where you have your wonderful newsletters and your discussions and your ideas.
So Hedge Fund Telemetry is an offshoot of the work that I did at the firm that I was a partner at. And it has a lot of market sentiment stuff. We look at 40 different markets. We have charts on 40 markets every night. So you don't have to wait a week and figure out what the sentiment is. It's charted. It looks great. And it's really helpful. It's part of the process. I look at DeMark indicators. I screen for within the S&P each day, and a bunch of ETFs of buy signals, sell signals. And we have a trade ideas portfolio, hedgefundtelemetry.com. We do have something new that I don't even think you know about, but it's coming soon. It's already out, but it's in beta version right now. It's called The Big Picture. And for people that don't necessarily want the day-to-day noise, which my stuff can be noisy and sometimes difficult to follow every day, it's a monthly note that looks at big picture themes.
Wow.
And it has a risk score. It has the base case, bull case, bear case for levels for the S&P. And from the people that have seen it and people that have already subscribed that are only Hedge Fund Telemetry subscribers now, I've had some of the best people that I know say that it's the best work I've ever done. So it's called The Big Picture. It's underpriced, which I've been told that too.
Value. It's value, not underpriced. It's value.
Listen, it's something that it helps. Having this, having Hedge Fund Telemetry helps my, pay for Bloomberg's and funds my research and what I do and what I love to do. So it's going to be good, and it's not for day traders. It's more for portfolio managers, registered investment advisors, and serious investors that don't want the day-to-day nonsense, but more, what's the big picture? Where am I going to make money over the next 6 to 12 months?
Right. Good stuff. Thanks for joining us. I appreciate it.
Thank you, sir.
Thanks for joining me this week and every week. That was a great conversation with Thomas Thornton from Hedge Fund Telemetry. As I mentioned, we have some great guests coming up. We have Claire Flynn Levy coming up. We have Thomas Thornton. We also have lined up Ed Easterling coming up as well next month, and a whole host of other people throughout the year. So I'm pretty excited. Next week, I'll be actually a guest on the Wall Street Unplugged show with Frank Curzio. So I'm looking forward to that. Thanks for joining me this week and every week. Go over to thedisciplinedinvestor.com if you want to understand more about getting back in, 1 foot in, 1 foot out, the lobster trap theory that we have on investing, and exactly how we do things, plus our TDI managed growth strategy, which is a long-short strategy, which may be just right for you if you're looking for both sides of the equation right now. You really should check it out. Love to work with you. Love to make sure that you are taken care of for your future. See you soon. This podcast is intended for informational purposes only and does not constitute personalized investment advice. Investing involves risk, including the possible loss of principal, and past performance is not indicative of future results. The views and opinions expressed are those of the host and any guests and may not necessarily reflect those of Horowitz & Company, Inc., an investment advisor registered with the U.S. Securities and Exchange Commission. Registration with the SEC does not imply a certain level of training or skill. Advisory services are only offered to a client or prospective clients where Horowitz & Company is properly registered or is excluded from registration requirements. Any mention of third-party companies, products, or services is provided for informational purposes only and does not constitute an endorsement. Hypothetical scenarios or forward-looking statements are for illustrative purposes and should not be viewed as guarantees. Content is intended for U.S. residents only and may not be applicable in other jurisdictions. Listeners should consult a qualified financial advisor before making any investment decisions. Please visit our website for additional information, disclosures, as well as a copy of our Form CRS. Advertisements are not related to the host or affiliates and are not considered recommendations by the host of the show or any affiliates of Horowitz.